Welcome to the deep dive. Today, we're really diving headfirst into the In Gold We Trust Report 2025.
hmm
And our focus, it's the core argument they're making, what they call the big long thesis. It's basically a renewed and pretty compelling case for significantly boosting gold's role in your investment strategy, like right now.
Right. And for you, the listener, we get it. Trying to keep up with global finance, all the geopolitical shifts, it can feel, well, overwhelming.
Yeah.
So our aim here is really to cut through the complexity,
Wow.
highlight the key reasons behind this big, long idea for gold, and explain why the authors think it's so relevant, potentially, for your portfolio.
Exactly. And this isn't just some short-term guess about gold prices. The In Gold We Trust Report 2025, it's a seriously comprehensive piece of work.
It really is.
It digs into how everything's connected: monetary policy, the massive scale of global debt, shifts in world power, the gold market itself, all of it.
So yeah, our mission is pretty straightforward. Pull out the most critical insights from this, well, pretty substantial report and lay them out in a way that's hopefully both informative and engaging. By the time we're done, you should have a really solid grasp on why the authors believe we might be at a pivotal moment that strongly favors gold.
Okay, let's unpack this big long thesis then. Now, the report's authors, they've been bullish on gold before, haven't they? This isn't entirely new ground for them.
That's right, exactly. The Big Long actually builds on their golden decade thesis from the 2020 report.
Ah, okay.
Back then, gold was around, what, $1,500 an ounce? The core idea is that the trends they spotted 5 years ago, well, they haven't just stuck around. They've actually sped up, become more pronounced.
And their recommendation, it's not just a suggestion to, add a little gold. They're pushing for a pretty significant weighting in portfolios.
Oh, absolutely. They strongly recommend investors put a substantial chunk of their portfolios into both safe haven gold and what they call performance gold.
Yeah.
It's not about a small symbolic amount. It's about building a real strategic position in these assets.
Okay, safe haven gold. I think most people get that physical gold bullion, the classic store value. But performance gold, let's dig into that a bit. What does that cover in their view?
Yeah, performance gold, as they frame it, it's broader than just the metal itself. It includes assets that historically tend to do well when gold prices are rising. So think silver,
Oh.
shares in gold mining companies, and even the wider commodity sector.
Right, right. Now, here's where it gets really interesting, I think. The report connects this gold argument to these much bigger sort of fundamental shifts happening globally. It's not just economics in a vacuum.
Absolutely. They argue that something like U.S. trade policy,
Yeah.
which often gets discussed on its own, is actually just one piece of a much bigger puzzle, a symptom of a really profound systemic shift in the global order. They even pinpoint something they call Liberation Day, tied to Trump's policy changes as a kind of trigger for fundamentally reshaping the whole global system.
Wow, systemic reshaping. That sounds pretty major. What kind of reorganization of the, global financial architecture do they see potentially happening?
Well, the report suggests we could be looking at a really significant reorganization of the entire global monetary system. The way things have worked for decades, that dominance, it's facing serious challenges from different directions.
And they use this analogy, don't they, about needing a fast horse if you tell the truth about gold, to show how it was kind of dismissed.
Yes, exactly. They quote that saying, if you tell the truth, you need a fast horse. The point being that for a long time, especially in mainstream Western finance, just suggesting gold was a real safe haven was seen as kind of old-fashioned.
Right.
And the idea of it actively performing, mostly dismissed, it really fell out of favor. And people banging the drum for gold often felt like they were on the outside looking in.
So fast forward to today, their view is that gold has shaken off that slow pony image. They actually paint it as pretty dependable, defensively speaking, in a portfolio.
Yeah, they use a great football analogy comparing gold to Ronald-Koeman, the Dutch defender, famous for being reliable at the back.
Ah, okay.
Gold is the Ronald-Koeman of asset allocation, defensively reliable. The idea is it can consistently offer stability, act as a protective element.
And they've mapped out a model portfolio reflecting this conviction, right? It's definitely not the old 60-40 stocks and bonds mix.
No, not at all. It's a big departure. They call it the new 60-40 portfolio. The allocation they propose is stocks 45%, bonds just 15%.
Wow, only 15% bonds.
Yeah, Then safe haven gold, 15%. Performance gold, 10%. That includes the silver, miners, commodities, another 10% specifically in broader commodities, and even 5% in Bitcoin.
Interesting.
It really shows their conviction about diversifying beyond the usual suspects and the very significant role they see for gold and related assets.
Let's focus on that U.S. trade policy piece for a second. You said it's key to this larger shift. What specific consequences does the report highlight?
Well, a major point is that because modern economies are so incredibly interconnected,
Right.
protectionist trade policies today carry much bigger risks of cascading failures across supply chains
Right.
than they did back in the 1930s. It's just a different world. They point out that over 2/3 of U.S. manufacturing firms actually rely on imports for components.
2/3. That's huge.
Yeah, so they're really vulnerable to tariffs and disruptions.
And the previous U.S. administration's stance, it was pretty assertive on trade, especially regarding the dollar's role, wasn't it?
Oh, definitely. The report mentions the repeated threats from the Trump administration, things like imposing 100% tariffs on countries trying to trade in currencies other than the U.S. dollar.
100%.
Yeah, it really throws that tension into sharp relief, doesn't it? Wanting a weaker dollar for trade competitiveness, but at the same time trying to force everyone to keep using it as the world's main reserve currency.
It sounds like walking a tightrope. Help exports with a weak dollar, but keep its global dominance. The report also gets into these shifting global power dynamics, especially what central banks are doing. What's the big story there?
What's really striking is just how much gold central banks around the world have been buying and consistently for 3 years running now. They've collectively added over 1,000 tons of gold to their reserves each year. That is a lot of gold.
1,000 tons a year for 3 years. Wow. And it's not just the usual suspects, is it? I mean, Asian central banks are big buyers, but 2024 had a bit of a surprise.
Exactly. While Asian central banks are definitely still major players, Poland actually came out as the single biggest buyer in 2024.
Poland, okay.
Yeah. And the report interprets this as being driven significantly by geopolitics. It reflects, a growing mistrust of the established Western financial system and maybe an acknowledgement of the rising economic weight of emerging markets. It's like they're voting with their vaults, so to speak.
Voting with their vaults, I like that. Okay, so central banks are making a statement. What about gold's actual market performance? It's hit some major milestones lately.
Oh, absolutely. Gold hit a new all-time high in 2024. The average price was $2,389 USD. And so far in 2025, the average year-to-date has been even higher, around $2,952 USD.
And importantly, that's not just a US dollar story, is it? The report makes a point about its performance in other currencies, too, over the long haul.
That's a really critical point, yes. Gold has shown consistently positive performance against a whole range of different currencies over the very long term. We're talking centuries here.
Wow.
The report highlights that just since the year 2000, the average annual return for gold in U.S. dollar terms has been over 10%. That's outperformed most other major asset classes and currencies over that same stretch.
Over 10% annually since 2000. That's impressive. They also use some ratios to gauge gold's value relative to other things, like the Dow Gold ratio. Can you explain what that tells us?
Sure. The Dow Gold ratio basically shows how many ounces of gold you'd need to buy 1 unit of the Dow Jones Industrial Average. Historically, when this ratio gets really high, it often suggests stocks might be overvalued compared to gold. And when it's low, it suggests gold might be relatively cheap compared to stocks. The report gives historical context, showing where we are now compared to past peaks and troughs.
And what about the size of the whole gold market compared to, say, the entire U.S. stock market? How does that stack up?
Well, the report calculates that the total market cap of all investable gold in the world is currently about 40% of the total market cap of all U.S. public companies.
40%. Okay.
And interestingly, they note that this is actually slightly above the long-term historical average, suggesting gold isn't, excessively large relative to equities right now. They also briefly look at the Nasdaq Q100 gold ratio for another angle, especially comparing gold to tech stocks.
Okay, let's switch gears a bit to debt. Always a big topic. The report points out some interesting fiscal policy shifts, almost like a role swap between major economies. What's going on there?
Yeah, they observe this potential role swap between the U.S. and Germany. The report suggests the new U.S. administration might be eyeing cost-cutting measures. They even make a slightly jokey reference to possibly using Dogecoin, while Germany, under its new leadership, seems set to increase government spending, especially on defense.
That's quite a turnaround, isn't it? But even with potential U.S. cost cuts, the overall government debt picture there doesn't sound great, according to the report.
No, it really doesn't.
Okay.
They flagged that the U.S. federal deficit might exceed 6% of GDP for 3 years straight,
Ouch.
which would be a concerning negative record. And they mentioned the U.S. hitting what's called the Ferguson limit. That's the point where government spending on interest payments on its debt actually surpasses total defense spending. That's a pretty sobering milestone.
Interest payments higher than defense spending. Wow. And while the U.S. deals with that, what's the European situation on debt and spending?
Well, Germany's plan to boost defense spending is significant, especially since it's apparently exempt from their usual strict debt rules.
Ah.
And the EU generally, the report notes, tends to use crises as chances to push for more central control and joint debt like the Next Generation EU Fund.
Right.
The report also compares the debt and deficit situations in France and Italy, pointing to recent credit rating changes that reflect those underlying fiscal pressures.
Okay, and we can't talk debt without talking inflation. Seems like it's been on everyone's mind. What are the key inflation trends and drivers the report highlights?
Well, the main point is that inflation has just been really sticky, hasn't it? Staying stubbornly above that 2% target in both the U.S. and the euro area.
Yeah, it really has.
And the main culprit seems to be the services sector. They also suggest U.S. tariffs have kind of reshuffled the inflation deck globally, maybe adding to inflation in the U.S., while possibly easing it a bit elsewhere in the short term, partly because energy prices came down.
So tariffs meant to protect U.S. industry might actually be boosting U.S. inflation. Interesting. What about the longer-term inflation outlook? Is a second wave possible?
Yeah, their uncertainty is still pretty high. The report doesn't rule out a second wave. They talk about longer-term pressures like demographic changes, aging populations, and increased global military spending, potentially keeping inflation higher for longer.
Right.
They also bring up this economic theory, the fiscal theory of the price level, FTPL. The basic idea is if a government has a huge amount of debt, it might struggle to repay through taxes.
Okay.
It could unintentionally cause future inflation as a way to effectively reduce the real value of that debt. Complex idea, but potentially very relevant. The report also touches on wage growth in the U.S. and euro area, China exporting deflation through falling producer prices, and then it summarizes all the potential inflation drivers. Energy, the dollar, wages, tariffs, deglobalization, government debt, rearmament, even CO2 pricing. Lots of moving parts.
Definitely a lot to watch there. Okay, moving to the gold market itself. Where's the demand coming from mainly these days? And what about supply?
The report highlights a really significant geographical shift in demand since the 2008 financial crisis. A clear move eastward.
Eastward.
Yeah, growing demand from Asia, driven by both a cultural affinity for gold and just significant wealth creation in the region.
Makes sense.
Central banks, as we mentioned, remain very strong buyers. Poland's big increase in 2024 being a key example.
Right.
Interestingly, though, Kazakhstan, Singapore, and Thailand were notable sellers in 2024. On the supply side, they mentioned Germany's Bundesbank using its gold reserves to offset some big financial losses.
Ah, okay.
And they also point out that hedging by gold producers in 2024 actually had a negative impact, effectively taking some supply off the market. But the overarching theme is gold's scarcity. It's finite and its resistance to political meddling or debasement.
The report also explores some pretty fascinating ideas about the future of the monetary system and the dollar's role. They even mention a potential Mar-a-Lago Accord. What's that about?
Yeah, the Mar-a-Lago Accord idea is presented as, a hypothetical but maybe plausible scenario. The thinking is the U.S. administration might strategically try to realign currency values, maybe because an overvalued dollar is seen as hurting U.S. trade or other economic goals.
So like the Plaza Accord back in the 80s.
Exactly. Something reminiscent of that, where major economies coordinated to bring down the dollar's value. It's speculation, but rooted in potential policy pressures.
And this could tie into ideas like a U.S. sovereign wealth fund or even gold-backed treasuries.
Yes, the report floats the possibility of the U.S. creating its own sovereign wealth fund like many other countries have.
Okay.
The idea is it could help rebalance trade by strategically buying currencies or other assets. And the concept of issuing U.S. treasuries partially backed by gold comes up too, as a potential way to boost the dollar's stability and attract long-term global investment. They even reference analyst Luke Groman's view about a potential dollar window. Closing the idea being, if foreigners become less keen on holding U.S. treasuries and stocks, Gold might have to step in to settle trade imbalances.
That would be a huge shift. The growing influence of the BRICS plus countries is another big geopolitical piece. How does that fit in?
The BRICS Plus group is definitely presented as a major force pushing towards a more geopolitically divided world, a bifurcated world, they call it.
Yeah.
The report notes the group's expansion and talks about the challenges, but also the progress they're making towards potentially creating their own currency or payment system for trade, maybe using commodity-backed settlements or blockchain tech.
Right, trying to build alternatives. And China's role in all this, aiming to be a systemic rival. That's key too, isn't it?
Absolutely. The report lays out China's strategy under Xi Jinping, aiming for more economic and tech self-reliance. Things like the Belt and Road Initiative are seen as part of this parallel globalization effort,
Parallel globalization.
creating an alternative network.
Okay.
The ongoing trade tensions with the U.S., China's push to de-dollarize, promoting the renminbi, plus the huge amount of private gold held in China. It's all part of this picture of systemic rivalry.
Okay, back to gold supply for a moment. There's an interesting section on Saudi Arabia potentially becoming a new gold mining frontier. What's the story there?
Yeah, the Arabian-Nubian Shield region in Saudi Arabia is apparently loaded with untapped mineral potential, including a lot of gold.
Really?
Yeah. The Saudi mining company, Ma'aden, has made some big gold discoveries, and they have these ambitious plans to quadruple their gold production by 2040.
Quadruple.
It's a big part of their Vision 2030 plan to diversify their economy away from just oil, and they're trying to attract foreign mining investment.
Hmm,
And significantly, the report also notes the recent end of that 50-year petrodollar deal between Saudi Arabia and the U.S., another major shift.
definitely. Another trend the report covers is central bank gold repatriation. Why are countries bringing their gold home?
This trend of central banks physically bringing their gold reserves back to their own vaults is driven by a few things. A desire for more asset diversification, hedging against rising geopolitical risks,
Mm-hmm.
and definitely concerns about potential sanctions or restrictions on assets held abroad. The report mentions successful repatriations by Germany and the Netherlands, and a failed attempt by Switzerland. Kind of points to an underlying erosion of trust in the current global financial setup.
Yeah, that makes sense. Let's not forget recycling that's important for gold and silver supply too, right?
Yeah, recycling is a really significant part of the global supply picture for both metals. Gold recycling tends to be pretty price sensitive. Higher prices mean more people sell old jewelry, that kind of thing.
Right.
Silver recycling is often more driven by industrial demand since it's used in so many applications. And the report also mentions e-waste old electronics as a potentially growing source of recovered gold in the future.
Interesting. Now, the report tries to sort of demystify gold's value, suggesting you can analyze it using similar ideas to how you might value, say, the S&P 500. How does that work?
Well, the authors argue that you can look at both gold and a BRICS stock index like the S&P 500 through the lens of similar principles specifically: liquidity, how easily you can buy or sell, and investor confidence cycles.
Okay.
So when investor confidence in traditional assets drops, gold often gets favored as a safe haven. When confidence rises, money tends to flow more into equities. They briefly mention their own incrementum gold price model, which uses these kinds of factors to set long-term price targets.
Got it. The report also tackles ESG, environmental, social governance in the mining sector. What's their take on that? It can be a pretty contentious area.
Yeah, they acknowledge the growing politicization of ESG. Their view seems to favor a more long-term, stakeholder-focused approach to sustainability in mining. They actually give specific examples of good ESG practices, companies supporting local communities, creating jobs, being environmentally responsible. They name-check companies like Caledonia Mining and Endeavor Silver as examples of firms doing positive things on the ESG front.
And what about the mining companies themselves? What's their main strategy right now? Grow like crazy or save money?
The report suggests a noticeable shift towards capital discipline. Rather than aggressive growth, even with high gold prices, many miners are being more cautious.
So not drilling everywhere just because gold is high.
Kind of. Production volumes for many majors have actually dipped a bit, and capital spending CapEx has been fairly subdued. The focus seems to be more on reducing long-term debt, finding a balance between stability and growth. They also note that active investing picking specific mining stocks has tended to beat passive index approaches in the sector.
Right. And speaking of miners as performance gold, the report has a tool for timing investments there.
Yeah, they introduced something called the incrementum active aurum signal. It's intended as a potential tool to help investors time their entries and exits in gold mining stocks.
Okay.
They point out that historically, mining shares have often done well when the Fed is easing monetary policy or when the broader stock market is falling. And they argue that high-quality mining assets might actually be undervalued right now compared to the gold price itself.
Undervalued. Okay. Now, silver, gold's little brother.
The report calls that section Searching for the Silver Bullet. What are the key drivers they see for silver?
Well, first, they point out silver's historical undervaluation relative to gold, that high gold-silver ratio we see now.
Right, it's very high.
Yeah. Then there's the growing industrial demand, which is significant for silver, especially in solar panels using that TOPCon technology. Apparently, it needs quite a bit of silver.
Ah, the solar connection.
Mm-hmm. They also mentioned silver's historical role as a metal of war, may be relevant again with rising military spending globally. And finally, its potential as an inflation hedge, using Turkey as a case study where silver has historically done well during high inflation periods.
And what about Bitcoin? It's increasingly part of the conversation. How does the report position it alongside gold?
They flag the emergence of the U.S. Strategic Bitcoin Reserve as a pretty significant development. It kind of suggests official recognition, maybe, of Bitcoin as a monetary good, even if alongside gold.
Interesting.
They talk about more nation-states adopting Bitcoin, innovative ways companies are getting exposure. But ultimately, they position Bitcoin not as replacing gold, but as a complementary reserve asset, something that can exist alongside gold in this changing monetary landscape.
Complementary, not replacement. Got it. Now, for something a bit different, the report looks at calendar anomalies in the gold market, like predictable patterns.
Yeah, it's kind of fun. They explore these recurring patterns in gold's behavior that seem linked to specific times of the year or month.
Like,
Things like a half-month effect, a holiday effect around Christmas. They also say the famous January barometer stock market indicator doesn't really work well for gold assets. And they even discuss the Super Bowl indicator.
the Super Bowl indicator.
Seriously. Apparently, there's a surprising inverse correlation between this Super Bowl outcome indicator and gold prices. Weird, right?
Is weird. Okay, finally, technical analysis charts, volume and market sentiment. What's the picture there?
Well, despite gold hitting new all-time highs recently, the report notes that overall market sentiment towards gold is surprisingly neutral.
Neutral, even at highs.
Yeah, which they actually see as a positive sign. It suggests the rally might have more room to run without being driven by excessive speculation or hype.
Okay.
They reiterate gold's long-term outperformance versus stocks since 1999 and mention some technical indicators that might point to potential short-term pullbacks, but the overall underlying technical trend looks constructive to them.
Okay, so pulling all this incredibly detailed analysis together, what's the final outlook for gold from the In Gold We Trust report 2025? They title the conclusion, Quo Vadis Aurum. Where are you going, gold?
They really double down on their view of gold as the GOAT of the portfolio.
It's the GOAT, greatest of all time.
Exactly. For diversification, inflation hedging, protection against counterparty risk, plus its liquidity. They talk about potential for a major revaluation of gold, partly due to how it's being valued more freely in emerging markets now. And they stick with their long-term price forecasts. The base case is still USD 4,800 an ounce by the end of the decade, the inflationary scenario. That goes up to USD 8,900.
4,800 base, 8,900 inflationary. Wow.
Yeah. They use this relay race analogy. Gold is leading now, but expect silver, then mining stocks, then commodities to follow. They really highlight that extreme gold-silver ratio, suggesting silver has major catch-up potential.
The relay race, I like that.
Of course, they acknowledge risks. Profit-taking, geopolitical tensions easing suddenly, a surprisingly strong U.S. economy, technical factors. Maybe a short-term correction down towards, say, USD 2,800 isn't out of the question. But the bottom line, they remain firmly in the big long gold camp.
Okay, so to wrap up our deep dive into the In Gold We Trust report 2025, the core message is this big long thesis, a strong call to significantly increase gold, both safe haven and performance types, in your portfolio.
Right.
And it's driven by these huge shifts: geopolitics, the monetary system, central bank buying, potential dollar realignment, the BRICS plus influence, stubborn inflation, all pointing towards gold. And they see big potential in silver and miners, too.
And this whole discussion really raises a key question for you listening in.
Wow.
Given everything we've talked about, the monetary trends, the debt dynamics, the geopolitical shifts, what could a truly stable, trustworthy global financial system even look like in the coming decades?
That's a big question.
It is. And maybe more pointedly, what role do you see gold playing in whatever that future system becomes?
Definitely something to think about. Hopefully this deep dive gave you a solid foundation for understanding the big, long arguments. We really encourage you to check out the full In Gold We Trust Report 2025 if you want even more detail. There's a lot in there.
Absolutely.
Thanks for joining us on the deep dive.